Hi, everybody. We are just about a month away from the inauguration, and consumers have heard plenty from this incoming administration that, if enacted, could have an impact on their finances, from big tax breaks to lighter financial regulation and tariffs. Now, something you may not know about CNBC is that we are unique among news organizations in having 4 working journalists who have earned the Certified Financial Planner designation. And all 4 of us are here today. We come from all areas of the newsroom, and we're here to help walk advisors through how to help their clients when they're talking about the news over the next 4 years of this new administration, and when and if you should be changing your financial plan based on the news headlines. My name is Kelli Grant. I'm the Deputy Personal Finance Editor for CNBC. Joining me are Darla Mercado. She's a Markets Editor for CNBC. Emmie Martin, CNBC Make It's Money Editor, and personal finance reporter Kate Dore. We're going to be taking your questions too, so please chime in the chat. Darla, I'd love to start with you. Can you tell us a little bit about some of the notable and unique investor behaviors that we saw during President-elect Donald Trump's first term and what we might be likely to see in this second term?
Sure thing, Kelly. Thanks for having me. I feel like the theme is risk on. And certainly when we're looking back at 2017, 18, 19, and 2020, largely we saw strong market performance. 2018 was kind of the exception there, where the S&P 500 fell about 6%. I think that while promises around deregulation and lower taxes helped sentiment, it's really important to consider the backdrop and not just who's in the White House. So, for instance, going back to that down year in 2018, we had this big sell off toward the end of the year as investors were afraid that the economy was slowing and that, basically the public was grappling with worries over an escalating trade war with China. I think another thing to consider as we look at how stocks had fared back in those times is to also remember that there are multiple inputs at play. So, certainly rate policy, for instance, that's a factor in the outcome as well. And then, especially when we look at a year like 2020, you had a customer or a consumer rather who was flush with cash from stimulus dollars, but then also we had the benefit of those rock bottom interest rates, which ultimately was um fueling some of that bullish sentiment, I would say.
Some
um
unusual factors for sure.
yes. And then kind of going into it this time around, I mean, we've got this market that's already roaring. The Dow's up almost 18% in 2024, and the S&P 500 has gained nearly 27%. And since the election, the Dow is up 5%, while the S&P 500 is up nearly as much. We're looking at a gain of 4.6%. So again, risk back on for the investors. With a little more attention, I'd say this time towards cyclical plays, hence that jump in the Dow. Um, Folks are betting pretty big on financials, small caps, and certainly people are really bulled up looking at crypto and Bitcoin. So, um, as far as the messaging, I feel like folks ought to take all of this risk taking with a grain of salt. It's very easy to get excited when things are kind of whipped up the way that they are. Really a great time to just sort of take a step back, revisit your asset allocation. And certainly, it might pain folks to think about trimming off a few of their winners, kind of getting into this rebalancing mode, particularly with the end of the year coming. But, hey, it might be time to do that. Do some prudent pruning, I would say. So.
And Kate, if I can get you to chime in here too, I'd love to talk a little bit about some of the financial planning trends you saw first term and now going into a second term. I know
Yeah,
taxes are a big focus for you.
absolutely, Kelly. And some of the key tax planning strategies that we saw during the first Trump administration happened both before and after the Tax Cuts and Jobs Act. So in 2017, before we had the bigger standard deduction, we saw advisors accelerating itemized deductions. Things like prepaying property tax bills, especially for those who would be soon impacted by the $10,000 cap on the state and local taxes. After 2017, of course, with the bigger standard deduction in place, we saw strategies like bunching charitable deductions, as well as the increased use of donor advised funds to accomplish that goal. And now President-elect Trump has said that he plans to fully extend all the tax cuts that were enacted during his first term. So we could see an extension of some of those post 2017 tax strategies.
All things to pay attention to. Now, I know for us as we're covering the news, sometimes we see these or hear about these client concerns that can be a little premature. So I'd love to talk a little bit about how we get from something that is an idea mentioned in a speech to something that is actually in action, because there are a lot of possible paths to this. I think it's probably something we can all speak to, but Emmie, I'd love to toss that one to you first.
Yeah, so there are several ways for a policy to come to life. It can come through Congress, through executive action, through agency regulation, all of these different ways. And if a topic or proposal feels relevant to our audience, we have to think about what is the likelihood that this is going to happen and what is its viability before creating stories that say, here's how you should react to this proposed policy. And so there are a number of competing priorities we have to remember despite Republican control of Congress. So not everything Trump mentions is going to happen. So how can we, as journalists and as advisors, give our clients and readers the best information for where something's at in the process? So we want to keep readers and investors informed, and we try to take it seriously when new policies or ideas are mentioned, but we're not going to cover everything or give actionable tips on everything, especially if it seems like it's going to be a long road for something to get from an idea to going through Congress to being enacted, all of that kind of thing. So our initial stories when we're covering it at CNBC are often exploring largely the mechanics of how something might work. We look into the viability of something, we talk to experts, and we're asking, how is this going to impact clients if it comes to fruition, and what is the path for it to get there? We don't want to scare readers into taking actions that could end up hurting them. We want to give an idea of how likely something is to happen, the timeline for how long it will be take to put in place. And then as these policies move forward, we're keeping an eye on that. And our coverage is going to move from here's how this might work to here's how to plan and how to implement strategies and adjust your portfolio accordingly.
And okay, when is the right time for us to jump in or for advisors to jump in and say, here's an idea, it actually looks like this is going to be enacted, and the right time to make a change for your financial plan or for your portfolio?
Yeah, so great question, Kelli. So back in 2017, advisors were telling their clients, this was before the Tax Cuts and Jobs Act was enacted, advisors were telling their clients, do not make major or irreversible changes before the final legislation is signed into law. And I think that definitely still applies here. Generally, it's better to focus on tax strategies that affect the overall situation and can benefit you regardless of what's happening in Congress. So, for example, I know this was mentioned during the last tax session. If you're looking at a Roth conversion, if you're in a low income year and it's for your client's legacy planning goals, that's probably still going to be a good move, regardless of whether Congress decides to extend the lower income tax brackets past 2025. And in the meantime, I love what Marianella said about getting your ducks in a row, as well as monitoring all the changes that are happening in Congress. You can run projections of all these different scenarios and be ready to pull the trigger for when Congress does pass something and when President-elect Trump signs it into law.
Now we have a question from the chat that I wanted to bring in. Benjamin is asking, is the YOLO and FOMO psychology compromising the long-term planning ethic? Definitely speaks to some of those first-term trends we saw, but who wants to take that one?
I'm like really pumped to take that one.
I figured you might be.
Actually, because I find that it's the kind of thing that certainly in the course of my own reporting, we always go and speak to, accountants, financial advisors, and kind of getting this sense that what may be the right move isn't necessarily the most easy move or the most fun move, or it starts to become one of those things where and it's funny, one of the issues where I sort of see this come up is the discussion around giving away or selling off some of these highly appreciated positions within a portfolio, and then going back, having this conversation on what it means for your risk exposure, the fact that, if you took the ride up, are you ready to take the ride back down? Kind of bringing people back to that reality. It's really funny to think about that because certainly it feels like 2022 wasn't all that long ago. You guys remember that back then, folks were seeing pain on both the fixed income side and the equity side of the portfolio. It felt like there was no place safe to go. But nonetheless, now that we're looking at 23, 24, we've got like this pretty strong, a whole lot of like momentum going into 2025. It's really easy for folks to kind of forget about that and forget about the pain of, having potentially too much exposure to certain riskier corners of the market. The funny part is that also in the course of my reporting, we're seeing it the other way around too. So I saw someone had a question on duration. Um, One of the things that we've been trying to get across is sort of this message of adding a little bit of duration. So basically, what we're talking about is adding exposure to longer dated fixed income issues, longer dated bonds. Not terribly, terribly long, as that would be too heavy on duration and you'd see a lot of potential price swings, but maybe looking at intermediate duration, something in the area of about 6 years or so. And what I've been hearing about is reluctance on the part of investors to get some of their idle cash out of those money market funds. Folks don't want to go and start snapping up some of these longer dated bonds, even as that would be the better move longer term, especially if you're a little too heavily weighted toward cash at the moment. So again, sort of this sentiment, what feels good to the investor isn't necessarily the best move for them. And
And I
that's what
think
we're
that's
seeing.
really true no matter who's in office ultimately. These are bigger societal forces that we are contending with. And there was another great question, I think, in the chat from Myra asking, what can those members of Gen X do to maximize the next 4 years to play catch up? We know that these are the sandwich generation, and we have written many stories around their lack of preparation for retirement, in part due to some of these extra forces that are outside their control. Kate, is that something you would be interested in talking a little bit about on strategies for them over the next 4 years?
Yeah, well, one thing I can point out right away is a big one for next year. If you have the ability, let's say you're higher income and have the ability to max out that 401k, for folks that are, 60, for folks that are turning 60, from 60 to 63, there is an increased contribution on top of maxing out the 401k. But again, I know it can be difficult for Generation X. They're juggling priorities from taking care of aging parents as well as children at the same time. So I do think that one of the key things is definitely just, taking things a day at a time, taking a look at your budget, what you can actually afford, and just making the most of the cash flow that you have and looking for opportunities as they arise. Take advantage of your plans at work. Take advantage of all the employee benefits that you have available to you.
Excellent. And we are just a minute or two away from wrapping up here. So, Emmie, I'm going to give you our last question. It's something we have talked about a lot in the preparation for this panel, but historically, how does the president affect the stock market as we're looking for something to leave folks with of what they'll need to think about for the next 4 years?
Yeah. Interestingly enough, despite all of the worry around how it will affect the market, the choice of president does not have a broad impact on the market. In research that I've looked at says that going back to Eisenhower, the market has only been down in 3 of the administrations. And so generally the market tends to go up, it tends to do the same. And who is in office is not necessarily the factor to look at. It's more important to consider economic factors, geopolitical factors, Fed policy, all of these kinds of things that can have an impact on the market. And interestingly enough, something that might come into play a little bit, but the market still tends to go up over time historically, is in historical terms, the market has been performed better when Congress is divided. So when the president and Congress are of the same party, we see lower returns, and we see that higher when it's divided. So we might see an impact there with a total Republican control. But overall, those are not the main thing to be concerned with. It does not have an outsized impact.
Okay. Well, thank you very much, our panelists, for joining us here today.